Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing CVS's stock so we can determine if it's a buy or a sell. CVS is the largest pharmacy chain in the US by locations and by prescription revenue. It has 9,000 retail locations, more than 1,100 walk-in medical clinics, and over 1 million patients served each year. It sells prescription drugs and a wide assortment of general merchandise, including beauty products, film, seasonal merchandise, greeting cards, and convenience foods. They also have an e-commerce platform at CVS.com. The company is headquartered in Woonsocket, Rhode Island, and was founded in 1963. Let's get started with the model. This is a large cap company, 87 billion market cap. They're trading at $68 a share, and they have 1.3 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. In 2019, they had over 10 billion of free cash flow. It increased about 30% to over 13 billion in 2020, then hit almost 16 billion in 2021. It dropped to 13.5 billion in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that grows from 6.6 billion to almost 8 billion in 2021, then almost cut in half to 4.2 billion in 2022. As you know, with inflation, prices getting higher, their profits getting squeezed. That's why their net income and free cash flow are lower in 2022 compared to 2021. Revenue is a sales for the company, and that grows each year from 256 billion to over 320 billion. Lots of revenue. A third of $1 trillion. They recently released their first quarter earnings, and this is their income statement. For the first quarter of 2023, revenue of 85 billion, up from 77 billion. 58 billion from selling physical products, up from 52 billion. 24 billion from insurance premiums. 2.5 billion from services, that is down a little bit from last year. And 334 million from investment income. I'll show you a different breakdown of their revenue. Of the 85 billion of revenue, 52 billion comes from the pharmacy, 6 billion from other products they sell in the store, 25 billion from premiums, 334 million of investment income, and 2.5 billion of other. They generate 26 billion from healthcare benefits, 45 billion from health services, and 28 billion from pharmacy and consumer wellness. They charge us 58 billion from selling physical products. They pay 51.5 billion for those products. So they make about 7 billion of profit on those items. Benefit costs are 20.5 billion, and then operating expenses is 9.6 billion. Those are all the expenses to operate the store. The payroll, the rent, things like that. Total operating cost 82 billion, up from 73 billion. You might have noticed opioid litigation charge. It was $500 million last year. This is from their 10Q. In November 2021, CVS was one of 3 pharmacy chains found liable. The court issued a judgment jointly against the 3 defendants in the amount of $651 million to be paid over 15 years. I think they appealed this. In December 2022, the company agreed to a settlement agreement. The maximum amount payable by the company under the agreement would be 4.3 billion in remediation and 625 million in attorney's fees. The amount will be payable over 10 years, beginning in 2023. Their operating income is down a little from last year. It was 3.5 billion. Now it's 3.44 billion. They spent 589 million of interest on their debt, a little less than last year. Income before taxes, 2.9 billion. Taxes, 737 million. Net income, 2.14 billion. Last year was 2.35 billion. So their EPS is 166, last year 179. They are buying back stock. Last year at this time they had 1.3 billion shares outstanding. Now they have 1.28 billion shares outstanding. They raised their dividend from 55 cents to 61 cents. This is their statement of cash flows, and the first section is operating cash flows. Operating cash flow converts net income into cash because net income is your accounting profit or loss. It's not actual cash. Their net income for the first quarter was $2.1 billion, but they actually generated $7.4 billion of cash flow. There are two ways to report cash flow from operations using the indirect and the direct method. Most companies use the indirect method, meaning they start with net income, then they add or subtract the non-cash items on the income statement, then adjust for changes in working capital. They use the direct method. You get the same result. Let's go through the direct method so you can see the difference. This method shows us actual inflows and outflows of cash, where if you look on the income statement, it uses accrual method accounting. They received $88 billion of cash from their customers, but their revenue was $85 billion. Maybe last quarter some customers bought on credit using accounts receivables and they're paying for it in this quarter. Because when you book revenue, it doesn't mean you received any cash. You might have sold all on credit. And it's possible to only book $10,000 of revenue in a quarter for your business and receive $100,000 from your customers because they may have bought last quarter and now they're paying for it now. They paid $50 billion of cash for prescriptions. They pay this to the insurance companies. They pay $20 billion of insurance benefits. They pay $10 billion to suppliers and employees for payroll. They receive $426 million of interest on their investments. They paid $773 million of interest on their debt. And they paid $75 million of income taxes. So they had a cash inflow of $7.4 billion. Last year, they had a cash inflow of $3.6 billion. Because the cash they receive from customers is $13 billion more this quarter compared to last quarter. Let's look at their investing section. They had a cash inflow from investments, $1.9 billion. They bought $2.4 billion of investments. These are usually short-term liquid investments, like corporate bonds or treasury bonds. They bought $1 billion of property and equipment. That could be the cost to buy real estate for some of their stores. They spent $7.1 billion on business acquisitions. So in their investing section, they had a cash outflow of $8.5 billion. Last year, they had a cash outflow of $2 billion. Last year, they really didn't spend much on acquisitions. In their financing section, they received $6 billion of debt. They paid back $362 million of debt. They bought back $2 billion of common stock, same as last year. They paid out $779 million of dividends, a little more than last year. They received $96 million from stock options, and they paid $34 million of taxes related to equity from their employees. So in their financing section, they had a cash inflow of $2.7 billion. When you add up the operating, investing, and financing sections, it comes out to $1.65 billion. So they had a cash inflow in this quarter of $1.65 billion. Last year, they had a cash outflow of $1 billion. Let's look at the capital structure. $71 billion of equity, $71 billion of debt. They're 50% equity, 50% debt. Their net debt is $55 billion. So they have about $16 billion of cash on their balance sheet. I give them a whack of 11%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $127 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $128 billion. We divide that by 1.3 billion shares. And we get a calculated stock price of $100. They're trading at 68, so they're trading at a 32% discount. It's a buy according to the model. Simply Wall Street is at 165. They say the stock is 58% undervalued. 16 analysts priced this stock, and the average price target is 95. The low is 76, the high is 120. Another 22 analysts priced this stock, and the average price target is 102. They say it's 50% undervalued. The stock IPO'd in 73, and they've done stock splits, so it looks like it IPO'd for under $2.50, but that's not true. It probably IPO'd for like $15, $16 like most stocks, but this is split adjusted. So you can see after a year, the stock was down like 70%. It got even lower after 2 years. That was its lowest point ever in 1975, 2 years after IPO. And then from 75 to 83, it really rose. It grew a ton, and they did a stock split. It did come down from the peak. I'm sure lots of people were saying, oh, this stock is garbage, don't buy it, just like people do with a lot of stocks. And in 1984, it was $4. And then it ran up to about $13 in 89. And then it got cut in half over the next 7 years, under $7.50. And that was at the end of 95. And then it doubled to over 14 2 years later in the beginning of 97. And you could see they started paying a dividend in 1985. And they've always paid a dividend since then. The stock is around 14 in 1996. And then it more than doubled, breaking through 30 in 2001. Then the dot-com crash, lots of stocks went down. So it fell to about $13 in 2001. It grew to over 40 by 2008. Then the Great Recession hit. It fell to about 22. And that was in 2009. And then it went from 22 in 2009 to over 110 in 2015. That was its highest point ever. From 2016 to 2019, it came down 50%. And then from 2019 to 2022, it went back up past 110, almost hitting its all-time high. But it's down about 35% since that peak at the end of 2021. So it looks like a good time to buy. This is not a fluke company or a fluke stock. They've been around 60 years, publicly traded for 50 years. If history were to repeat itself, it's going to go past $100 over the next few years. Hopefully sooner if you own the stock, but it's pretty much inevitable it's going to hit $100, whether it be a year from now or 5 years from now, I don't know. They pay a quarterly dividend. It was 50 cents in 2018. It's up to 61 cents currently. It's a yield of 3.6%, which they can easily afford. It's only 23% of their free cash flow. It is 75% of their net income. There are 12 companies in the same industry as CVS, and if CVS has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They're in the industry healthcare plans. Even though when I think of CVS, I think of a retailer. But a bulk of their business is the pharmacy. They spend a lot on CapEx, second most on this list, $2.7 billion. They have the worst debt to equity ratio of any company on this list. For every dollar of equity, they have $1 of debt. They do pay the highest dividend by far, 3.6%. They generate the second most free cash flow. United is the most by far. They rank third in market cap, a little behind Elevance, a lot behind United. They have a great price to book ratio. Price to book is market cap over equity. Equity is on the balance sheet, it's assets minus liabilities. Their PE is pretty close to the median. That's market cap over earnings. Earnings is on the income statement. They have an amazing price to free cash flow, 6.5. That's market cap over free cash flow. And their price to sales is 0.3. That means their revenue is about triple their market cap. Price to sales is market cap over revenue. They almost generate the most revenue, a little behind United. They have a solid 5-year annual revenue growth rate of 12%. The median is 12%. The average is 16%. Look at Cigna, 34%. Let's go through all their PowerPoint slides from their first quarter presentation. Q1 results, 11% revenue growth, 165 GAAP EPS, 220 adjusted EPS. Adjusted means they're removing things like stock-based compensation. Cash flow from operations, $7.4 billion. Shareholder value. They acquired Signify Health, big acquisition. They acquired Oak Street Health. The return to shareholders through quarterly dividends, $779 million. They bought back 22.8 million shares of common stock. Their 2023 guidance is revenue of $348 billion up to $353 billion. If they do that, it'll be the highest revenue ever. Adjusted operating income, $17.5 billion. Earnings per share, $8.60. Operating cash flow, $13 billion. Our strategic imperatives: grow our foundational business, harness cutting-edge technology, advance care delivery and health services offerings, empower our people and culture, reimagine our omni-channel health experience. Our vision: become the leading health solutions company for consumers. Deliver a superior healthcare experience for consumers. Drive improved health outcomes, lower costs, higher levels of engagement, and broader access to high quality care. They formed new health service segment and created pharmacy and consumer wellness segment. They made some accounting changes for insurance contracts. They adopted a new accounting standard using a modified retrospective transition method. The standard requires review of underlying cash flow assumptions at least annually, impact of changes reflected in earnings. So the impact of Q1 2022 up 42 million, the impact for full year 2022 up 162 million. This impacts several of their businesses, including Medicare supplemental, also long-term care and large case pension operations. The impact of net realized capital gains or losses effective for the first quarter of 2023, impact is excluded from adjusted operating income. This enhances their ability to compare past financial performance with its current performance and analyze underlying business performance and trends. This is consistent with how Aetna reported these items prior to the acquisition. Aligning our segments with our strategic vision, healthcare benefits, full range of insured and self-insured medical, pharmacy, dental, and behavioral health products and services. Health services, pharmacy benefit management solutions, as well as specialty pharmacy and other services. Multi-payer healthcare delivery capabilities, including primary care, retail health clinics, home health services, and provider enablement capabilities. Traditional retail pharmacy, specialty and mail order pharmacy fulfillment, and infusion services. Wide assortment of health and wellness products and general merchandise sold at community locations and online. We looked at some of these numbers already, but it can't hurt to look again. Q1 2023 revenue 85 billion. Adjusted operating income down 5%. It's currently 4.37 billion. GAAP EPS 165 down 6.8%. Adjusted EPS 220 down 4%. Cash flow from operations up 108% to 7.4 billion. They increased their targets. Last quarter, they said their revenue target for 2023 is 333 billion up to 338 billion. They raised it to 348 billion up to 353 billion. They also raised adjusted operating income, but they decreased GAAP EPS, those margins getting squeezed. They also decreased adjusted EPS. Cash flow from operations they kept the same, 12.5 to 13.5 billion. In the healthcare benefits segment, revenue is up 12% from 23 billion to 26 billion. And their forecast for this segment is higher, 102 billion to 104 billion. They received the City of New York Medicare Advantage plan contract. That's one of the largest client wins in Aetna's history. And they expect a 12% membership growth in Medicare Advantage in 2023. Health services is up 13% year over year. It's 45 billion. Operating income up 14%. Claims process is up 3.7%. And they also projected higher revenue in 2023 in this segment, 178 to 181 billion. Revenue up 8% in pharmacy and consumer wellness. Pharmacy prescriptions grew 2.5% year over year. It's right here. And if you exclude COVID vaccines, it grew 4.5%. Front store and pharmacy up 8 basis points. Retail pharmacy scripts up 26.8%. Same store growth is an important number when looking at retailers. Total sales up 11.6%. Pharmacy sales up 12.7%. Front store sales up 7.7%. That's just comparing the same stores from one quarter to the next. In other items, interest forecast is 2.7 billion. Last quarter, they projected interest for the year of 2023 will be 2.23 billion. Same capex spend, 2.8 to 3 billion. Same tax rate, 25.5%. They do project less shares outstanding, so they're going to buy back more. And same cash flow from operations, 12.5 to 13.5 billion. They talk about buybacks right here. Lower share count driven by our accelerated share repurchase transaction yielding more shares than initially projected. They're revising down their EPS to 850 to 870. And that's mainly from their Signify and Oak Street acquisitions. Originally, they projected 870 to 890, but these acquisitions are going to detract 35 cents per share. Lower COVID volumes is going to reduce 11% from EPS, and they're going to lose 7 cents from 340B risk. But they're buying back stocks, so that's going to add 4 cents per share, and net investment income is going to add 29 cents. So to summarize, I have them trading at a 32% discount They've been around 60 years and they're continuing to grow. So I think it's a pretty low risk. Plus you get a good dividend. I rank their free cash flow 6 out of 10, their revenue 10 out of 10, and their ratios 8 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you want to become a member, you can click on the link in the description below. Thanks for watching.